Good morning. Today is Wednesday, July 8th, and we are excited to bring you another edition of the Market Commentators podcast. My name is Matt Salm. I'm an investment analyst with the Milwaukee Company, and joining me this morning is Andy Wilms, who is the Milwaukee Company's president and CEO. Normally, Mike Wilms joins us as well, but unfortunately, he is unable to make it this morning. And also a quick reminder that nothing in this podcast should be taken as investment advice. So with that, Andy, good morning.
Good morning to you, Matt. Thank you. Good to see you.
Yeah, you as well. How was your holiday weekend?
It was great. Thank you. And yours?
Quite enjoyable. Yeah.
Good. Glad to hear it.
Didn't have the usual fireworks, but still good to be around loved ones and such. So
absolutely, absolutely.
You want to kick us off with a recap of what we've seen, not just in the past week, but perhaps so far this year?
Well, the end of June marked the completion of the first half of the market year, so to speak, and it was quite the 6 months that we've been through, all of us as investors and investment advisors. The S&P reached a high of just under 3,400 on February 19th, which was up almost 5% for the first 2 months of the year. And then, as we all know, the bottom fell out of the market in March, as stocks fell by over 30% to 2,237 on March 23rd. Then from that low, the market recovered almost as quickly to 3,100 by the end of June, which is just a 4% year-to-date decline in the S&P, and that's even less when you factor in dividends.
Yeah, absolutely. And then what about just some action from the past week or two?
Well, since last week, the Dow, the S&P, and the NASDAQ all were up considerably higher. The Dow was up over 3%, the S&P rose 4%, and the NASDAQ was up a little over 4.5%. And then just this week, stocks were sharply higher on Monday, led by strong gains in the tech sector, with Amazon, Microsoft, and Google parent Alphabet all climbing by at least 2%. Yesterday, Tuesday, the stock market appeared to lose some of its optimism as coronavirus cases in the U.S. continued to climb. And the Dow fell for the first time in 3 days. The S&P 500 closed lower for the first time in 6 days. And the NASDAQ retreated from its record high close on Monday. So today makes another day. The market started open a little higher on this at the time of this recording on Wednesday morning, but it doesn't take long for the market to change direction this year, that's for sure.
Yeah, absolutely. And what you mentioned about it losing optimism yesterday as coronavirus cases advanced, I personally would have expected that to maybe continue, given that yesterday we saw the single highest daily increase so far in the U.S. In terms of new infections, just over 60,000. But that surge in infections hasn't necessarily been accompanied by an increase in deaths. So there are, I guess, reasons for optimism in there, which we can talk about a little bit as far as what investors or what the market seems to be pricing in.
Sure. The surge in deaths may just be a delayed statistic. It may take a little while for that to show up. Jim Perserno, our director of analytics, who has done a lot of analysis in this area and keeps a daily track of it, indicated that yesterday there was a spike in the number of deaths, and in his announcement this morning, or the data he sends out to us each morning. And what's unclear is if this is just an anomaly. Sometimes a state will catch up on or reclassify deaths as coronavirus when they weren't originally, or if this is really an indication of what could happen in the future. If the number of deaths sharply picks up, along with the number of cases, that will be a big problem for the market. Now, that's far from certain, right? Because a lot of the new cases now are being focused more on younger people who have a much, much lower mortality risk than older people. And the treatment has improved dramatically. And we're not seeing hospitals get overwhelmed even though the number of cases are higher than they were before. We're not seeing a shortage of ventilators like we were worried about in the past. So it's very uncertain whether or not this increased number of cases will result in increased deaths, or if we've gotten a handle on the treatment of this disease enough such that it won't be as problematic as as was once feared.
Yeah, and I personally tend to be a bit more pessimistic and tend to think maybe it is just a delay in deaths catching up to new infections. And certainly, want to be very cautious in the outlook, but the market doesn't seem to agree, with that. It seems to more so take the opinion that we've gotten better at treating this. We have a bit of a better hold on it, and it's at least seems to think we're not going to go into lockdown again.
Well, I've been have a similar mindset, and that's why we've had our clients adopt a more defensive posture throughout all of this. But Mr. Market said, says otherwise, and you can have very good, as you well know, Matt, a person can have very good reasons for doing what they're doing when it comes to investing and still be punished for having made that decision, right? So even though there's great logic to the idea of being cautious here, that doesn't necessarily mean that that caution is going to be rewarded.
Yeah, that makes sense. One other update I wanted to share related to COVID-19 was a bit about Operation Warp Speed here in the U.S. It's the government's program to fast track a new vaccine to try to develop and distribute one faster than it's ever been done before. So it's unclear if it's going to work. There are some things that money can't buy, and throwing money at scientific problems doesn't instantly solve them, but it can certainly help. Right, it can certainly accelerate the process, and that's what we're hoping to see here. So, as listeners might remember, the government doled out significant amounts of money to Johnson & Johnson and to Moderna back in March and April to work on their vaccines, and we talked back in May about $1.2 billion that they gave to AstraZeneca, because AstraZeneca was partnering with Oxford University to try to develop a vaccine. But OWS just gave out its largest sum of money yet of $1.6 billion to Novavax, and they announced that yesterday. So we're still obviously, waiting to see how effective this is going to be in the end. But if throwing money at the problem can help solve it, we're certainly doing our part, right?
Right, and I have to admit, I'm basically a free market economist kind of guy, economy kind of guy at heart, and so but I have to admit, there's no way that the free market could come up with this kind of money to invest in the types of treatments that we needed. Here is an example where you really do need the support of big government to make these incredible expenditures if you're going to treat this kind of a problem. And that makes sense because it wasn't an economy created problem, right? So the economy acting on its own would have a very difficult, or not, if not impossible, time dealing with it. So there's a lesson in this for all of us, and it shows that you do need to have this ability of the government to step in and invest massive amounts of money. What'll be interesting to see is how people will respond, and I'm interested how you'd feel, Matt, if this Operation Warp Speed expenditures don't lead to an effective, long-lasting vaccine, right? And people start to complain that the government just wasted a lot of money. Do you think that would be a fair criticism, even if it didn't pan out, or would you be more of the mindset that you had to do what you can and hope that what you're doing would be effective?
Yeah, I definitely have more of the latter mindset. And I also think that given the trillions of dollars that have gone into stimulus in recent months, if people are going to get upset about, the billions that have gone towards vaccine development, I would think there are bigger fish to fry if we want to cut government spending than a few $1 billion on a potential vaccine. And what about yourself?
Well, I tend to agree. Everybody can play Monday quarterback, you know what I mean? See, well, we spent this money, how effective was it? In some cases, that's very appropriate, and I think it may be very appropriate with respect to the stimulus, right? If it turns out we spent trillions of dollars on stimulus and it didn't really help discontinue the spread of the disease, because as soon as we pulled off the social distancing restrictions, we were right back where we were, or worse. Then all the money we spent to keep people at home, maybe that was not the greatest thing to do, or we needed to spend more to keep people at home longer. I just don't know, and I don't hazard to offer an opinion. But I do feel that we have to try whatever we can to develop a vaccine, and as long as the government is being as careful as you can under the time frame that we have to operate, I don't think there should be any criticism if, in fact, the money spent doesn't necessarily result in a vaccine right away.
Yeah, and it's also important, I think, to listen to leaders such as Dr. Fauci or other public health experts to even understand what a vaccine is and what it might look like. You won't necessarily have lifetime immunity from taking a COVID-19 vaccine once. It might be something where you have to take it, once a year, similar to the flu, or potentially even more often. And so then there's the problem of how do we, get people to take the vaccine as frequently as they need to. And so it's not an easy problem to solve, I guess. Even if you get the vaccine developed, getting 300+ million people to take it, it'll be a struggle.
Absolutely.
Okay. So I guess we'll transition now back to more of the economics and markets stuff that we spend most of our time talking about. Andy, do you want to introduce our first topic of discussion?
Sure, I'll be glad to. Much of the economic data reported recently is suggesting that we are, in fact, in the midst of a V-shaped economic recovery. You might remember a few podcasts ago, going back a couple of months, we talked about the fact that the market was clearly in a V-shaped recovery, but I predicted maybe that the economy would recover sort of as a Nike swoosh, more of a gradual one. Well, so far, that has not been the case. It's been a V-shaped economic recovery as well. And that was really brought out by the fact, by some data that was released last week when we learned that the last Monday's ISM non-manufacturing index came in at 57.1%, which was an increase of 11.7 percentage points over May's 45.4 reading. That was the largest single month increase in the index history going back to 1997. And the week before that, when we didn't have a podcast because of the 4th of July, but the ISM's purchasing managers index jumped into expansion territory, with the PMI coming in at 52.6%, up 9.5 percentage points. So far, it seems very clear that we've had a V-shaped economic recovery up until this point. And the question is, do we think that's going to continue? And why or why not do we suspect that?
Yeah. So the first thing that stands out to me is actually the data themselves, and the month-over-month readings look extraordinarily positive. So the change from May to June was a big leap forward. But if we look at data that's sliced in slightly different ways, such as year-over-year data, it tells a very different story. And so I'm personally not surprised that last month was, the single largest increase in the ISM's non-manufacturing index's history, because I think April was the single largest decrease in that index's history, and May was also a really big decrease. And when you're starting from a low point, it just makes sense to me that the data is going to bounce back really strong. I think, like you said, whether or not that's going to continue and how quickly we get back to where we were pre-crisis is a big question. I tend to be a bit more pessimistic on that, but I'm curious what your thoughts are.
Well, I agree with you that the growth to date is largely due to the snapback effect that follows a sudden sharp decline in output. But I also feel the recent data clearly shows that the coronavirus recession has bottomed and the economy and the recovery is unfolding so far. The mystery is whether that recovery will persist. And the primary reason for the mystery, of course, is the uncertainty linked to the COVID-19 outbreak. And on that front, I think a critical factor is the development of a vaccine. And since we don't know whether or not there will be a vaccine, and how effective it'll be and how long its efficacy will extend, as you pointed out earlier. It's just really too soon to say whether the V shape will recover or not. I can see either one taking course, and I just don't know I don't know enough about the development of the vaccine and its prospects. I don't think many people do, to really have an informed conclusion as to whether that will continue on the V-shaped course, or we might end up with a W or something along those, or the swoosh or something else along those lines.
Just hopefully not an L.
Right? Yeah, hopefully not an L. That's exactly right. Oh, that's still not off the table either. Where we could have, if it takes a long time to get this vaccine in place, and the number of deaths go up, and the hospitals do start to get overrun, and things like that, then an L could ultimately happen.
Yeah, there's certainly reason for caution, cause for concern.
Yeah, well said.
Yeah. So our next discussion topic was going to be, I guess, about the competitiveness of U.S. stocks versus stocks from other countries. So to introduce that a little bit, I'm sure people are aware that the coronavirus pandemic has struck nearly every single country in the world by now. Only Turkmenistan and North Korea have not reported cases officially, but that doesn't mean that they don't have cases. So it's probably in every single country in the world. And some countries have done a better job than others at containing the spread of the virus. In particular, a lot of countries across Asia have done a good job convincing their citizens to do their part via social distancing, and they seem to have gotten their economies back on track to a pretty decent degree. And so while the U.S. Stock market has outperformed pretty much every other stock market in the world over the last 3 years, last 5 years, it's unclear if that's going to continue. So what are your thoughts on that, Andy? How important is containing the spread of COVID-19 to a country's ability to have, strong stock market returns in the future? And in particular, does the U.S. stock market still look attractive, given that some other countries might get their economies back on track sooner?
Well, first of all, I would say that, it is clear that there are other parts of the world that have seemed to have better results with the way they've treated or handled the disease than the U.S. has, right? I mean, we're kind of like ground zero at the moment. But that also, the societal differences between their countries and our country that allows them to control the virus more effectively isn't necessarily an advantage in the long term, right? Our basic freedoms and our love of freedom has caused a problem when you're trying to treat something like COVID-19 for some people. But overall, we would probably say that if you wouldn't give up our way of living because it was more effective at controlling pandemics, right? But it's true that, and they deserve credit, that these countries, several of these countries, have been better positioned to deal with it. I'd also say that one of the most effective parts of what the Asian countries have done is, adopted the wearing of face protection, much more so than we have in this country. We've been very lax, in my opinion, as to the use of face covering. And I've caught myself many times, being critical of myself for not having my mask on when I wish I had. But then again, in Asia, they've dealt with such massive amounts of pollution that they've been wearing face masks for years. I mean, it's nothing new. And so it's been part of their day-to-day life for a long time. And since our air pollution problems aren't nearly as great as those in China and other parts of in Asia, we have never had an occasion where we had to wear a face mask. So it's going to take a transition. So I think that's understandable. Now, that all being said, and trying to defend the American way, I guess, but that all being said, I do think that there's a reason to think that international stocks, and especially in certain parts of the emerging market countries, will start to catch up relative to their performance to the U.S. And I think we're coming to a time where maybe those of those of us investors who have been diversified, and by including significant allocations of international and emerging market, developed and emerging market international countries in their portfolios, maybe the tide has turned, and now we'll start to see people starting to get some reward for having done that. So my advice to investors, even though you've seen this tremendous performance in the U.S. stock market relative to the rest of the world up to this point, don't change your feelings about diversification. I mean, it's still, to me, the most important way of managing risk.
Yeah, well, and arguably now more than ever, because there's so much uncertainty with regards to how the pandemic is going to unfold. And so you don't just want to, if you're going to invest in international stocks, you don't just want to pick one or two countries. You would want it to be diversified across a broad basket of countries, right, with the hopes that some of them are going to do really great, even if others slip up.
Right, and we've seen the Chinese stock market rally like you can't believe the last few weeks. I mean, it's really been remarkable. What China has enjoyed, and you having lived there, you know much more about the culture that has allowed them to manage the pandemic that started there much better than we have here.
Yeah, it's interesting when you dive a little bit deeper into it that different countries across Asia did manage it differently. China's response was different from South Korea's, was different from Taiwan's, was different from Vietnam's. But yeah, they all seem to do quite a good job.
And their cultures are all quite different, and their political systems are all quite different, which reflects the manner in which they dealt with the disease.
Yeah. So one other topic was going to be related to U.S. stock market returns. We mentioned that the S&P 500 is only down 4% year to date, which I still think is a pretty astounding statistic given everything we've gone through in the last 6 months. But the median return of the S&P 500 is actually minus 11% on the year. So given that, and given that the returns have essentially been quite concentrated in a few mega cap tech stocks, what does that mean for the future of the stock market's returns? And can it continue to be that concentrated for a long time going forward?
Oh, well, it has been for a long time in the past, right? I remember seeing things in 2011 talking about how concentrated the returns are in the S&P 500. And I don't know, Matt, if you remember this, but there had been equal weighted S&P 500 index funds, which are down 11% because each company is represented the same regardless of the size of the company. And that's what you're referring to when you're talking about the fact that the median is down 11%. But they were all the rage for a very long time, right? Because the median, the equal weight S&P 500 had outperformed the regular market weight S&P 500 dramatically for a number of years. So a lot of this, is transitional, but it's important to recognize this is not a new phenomenon, but it's gotten to an extent now that's unprecedented. And I think that's your point. And, that means that the biggest companies by market cap are the most expensive, right? By traditional valuation metrics. And the smallest companies, on the other hand, are the least expensive by traditional valuation metrics. And they've also had the worst returns this year. So this suggests that, to me, that the smaller cap companies have more potential upside. If you believe in the old reversion to the mean, and if you're sort of a value-based investor, smaller cap members of the S&P 500 and smaller cap companies in general probably have more potential upside. But that doesn't mean that potential is going to be recognized this year or even next year. You can have disparity like this for a considerable period of time. But if you're diversified and you have exposure to small caps as well as the large caps, and you're not just entirely in the S&P 500, then you have the patience and you have a 5-year investment window versus a 3-week investment window, then I think perhaps it's very wise to recognize how this disparity and adjust your portfolio accordingly. And the last point I'll make on this topic, Matt, and then I'd be interested to hear what you have to say is, but when you have it's really basically 5 or 6 stocks that a lot of this growth has been concentrated in, right? I mean, you have 5 companies representing over 20% of the S&P's market weight or value. So that means the specific risk has increased dramatically, right? One of the reasons you invest in a broad index like the S&P 500, or what you believe to be a broad, is that one company isn't going to tank the index. So you don't have a lot of specific risk. Right now, that's not the case, right? If Amazon has a bad development, right, really, really bad, I don't want to hazard what it might be, but let's say something really terrible comes out about Amazon and that stock tanks 20, 30, 40% as a result. Not that I'm predicting this, I certainly am not, but if it were to happen, that would really have a dramatic impact on the S&P 500. So there's a lot of specific risk, which is precisely why you tend to avoid, you tend to use broad market index funds in a portfolio. So that's probably my greatest concern, is how it's introducing a lot more specific risk into clients' accounts that have a large amount invested in S&P 500. And, there's a lot of different ways you can address that, probably beyond our scope today, but your advisor should be able to help you address that issue if it's something you are concerned about as well.
I mean, it's just undeniably true, right? That specific risk has increased. The tricky part in my mind is how you navigate that, because there's as many strong arguments that those tech companies are going to continue to soar as there are strong arguments that they could stumble. And so recognizing that there might be some potential upside you give up by diversifying away from the market weighted index. And it just, I guess, comes down to your personal preferences and risk tolerance.
Well, but I agree with you. But that risk, right? That debate on whether that Facebook is fair, has so much upside that it's worth paying a huge premium for, or not, because of these whole issues concerning Facebook's policies, or you say something about that's true with every stock, right? Because if you believe the market efficiently priced stocks, by and large, I mean, on an individual basis, there's just as many people who buy a stock at a certain price that think it's going to go down as there are people who buy it thinking it's going to go up, right? So you have these two competing groups at any given moment in time. So whenever you pick a winner, when you're investing in the S&P 500, you're making now a bet on that those 5 companies, or whatever, 6 companies, however you want to measure it, will continue to outperform. And that's really kind of what you're making that bet, and that's not what index investing is typically about.
Yeah.
So if you wanted to make that bet, you would normally invest in those 5 companies, not in the S&P 500 index. Now, it's granted, there may be 20-25% of the index, so there's still a considerable amount of diversification, but we're getting further and further away from what an index would normally be. And this was always the criticism of the Dow Jones Industrial Average. We had 50 stocks in it, right? So they said we need a broader index because there's too much specific risk with just 50 stocks, and that's what ultimately has led to the growth of the S&P 500. That concern of specific risk, and now it's right there. So a simple way to deal with the problem would be to add some of the equal weight S&P 500 to your portfolio. As concentration in the S&P goes up, you gradually add an allocation of the S&P 500 equal weight index to offset that concentration.
That makes sense to me. I'm on board with
that.
I
think so.
Cool.
Your paycheck is safe for another week.
Oh, that's funny.
I got on you because I don't have Mike here to
Should we move on to closing thoughts?
Sure, go ahead.
Okay. I think the biggest thing I would want to say is reiterating a previous point about international diversification. That it's probably great for risk management, especially in this type of scenario, but it's worth taking the time to understand the details of the type of fund that you're investing in, because what you just said about the S&P 500 being quite concentrated, that's also true about a lot of index-based international stock ETFs. And so, it's a problem across different types of indexes. So take maybe a little bit of time to understand that, or if you don't want to do that, talk to your advisor to make sure that your international exposure is actually diversified and that you're not just concentrated in, Japan, China, and the United Kingdom.
And those indexes being very concentrated themselves. That's an excellent point, Matt, and a very good point indeed. And for me, I think what I would caution investors is that, right now adding some safety, taking a little lower equity allocation has not worked out well for those that have done it. And whether or not they'll eventually be rewarded or not is yet to be told. But even if it turns out that the market goes nothing but higher from here, I think investors who have been a little defensive need to be careful not to regret that decision and to change who they are as an investor. Because the fact that, that happened, for example, in a lot of Depression era investors, when they got crushed during the Depression, they never went back to stocks again because they were hurt so badly. And that really cost them, right? Because they missed out on a tremendous opportunity. The same here. If people really get too concerned about the fact that they were defensive when the market kept going up and swear off they're never going to do that again, the next time we deal with a crisis, they may stay overly offensive as a result of their experiences now, which ultimately could end up being a big problem. So I think it's important to be careful not to fall into that trap.
Yeah, FOMO is real. Try to avoid it.
Yeah, exactly. Very well said. Exactly.
Yeah, cool. Well, yeah, thanks again for joining this morning, Andy. This was a lot of fun. I hope our listeners enjoyed it as well. And if you like the podcast, remember to like and subscribe on YouTube, Spotify, or wherever you get your podcasts. Also, feel free to leave a comment on the videos or to reach out to us via email at firm@milwaukeecompany.com if you have any comments or questions, and we'd be happy to discuss those comments or questions on the show. In addition to the podcast, the Milwaukee Company puts out a weekly newsletter on Fridays where we have several people contribute to that. So I'd encourage people to check that out on our website. And we are active on Twitter at the Milwaukee Co., tweeting things related to finance, economics, and the markets, but also putting out some news about the firm from time to time.
And speaking about news of the firm, we'll have some exciting news about Mike next week, which I will share with everybody then. And Mike, we did miss you. Look forward to having you rejoin us next week. And in terms of the newsletter, let me also point out that I will be writing an article this week in the newsletter that will discuss more about this whole concentration issue and how much of a problem that is and how you might respond to it.
Sounds great.
So, all right. Well, Matt, great. Have a good rest of your day, and thank you all for joining us.
Talk to you later. Bye.
Bye-bye.
This podcast is for general informational purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an independent financial professional or independently research and verify information presented in this podcast before acting on it.